Warning bells are sounding for the global economy, and they are sounding out the increasing possibility of a global recession. The International Monetary Fund's outlook for 2022 and beyond has dimmed. We'll get into what a global recession would mean for Africa and if there is a way to avert it. And in 20 years of financial transactions on the Nigeria Exchange Limited, 121 firms have been delisted. As the market returns to positive territory, we'll discuss the issues thrown up from news of the delistings. This is Business Edge. I'm Tolulope Adeleru-Balogun. Let's start with African business headlines. Flutterwave has denied involvement in any financial improprieties in the guise of providing merchant services, as contained in recent reports from Kenya. In a statement, the financial technology company said that claims of financial improprieties involving the company in Kenya are extremely false, and they have the records to verify this. The statement continued saying that through our financial institution partners, we collect and pay on behalf of merchants and corporate entities. In the process, we earn our fees through a transaction charge, records of which are available and can be verified. As a business, we hold corporate funds to support our operations and provide services to all our customers. The company is reacting to allegations of card fraud and money laundering, as well as the freezing of several bank accounts in Kenya. And staying in Kenya, the country is seeking to limit Zambia, Tanzania, and Uganda from exporting maize to other countries at its expense, in fresh efforts to curb the surge in maize flour prices, ease inflation, and decrease the pressure on household budgets. Agriculture Cabinet Secretary Peter Munya says the country has opened talks with the three others to guarantee Kenya a share of the maize export to plug the shortfall in supplies. Crop failure due to poor weather and a shift in the movement of Ugandan maize to South Sudan has seen flour prices rocket to a record high of 210 shillings for a 2-kilo packet, up from 120 at the start of the year. This has triggered a rally in inflation to a 58-month high of 7.9% and has forced families to skip meals and cut orders for other things like airtime and beer. Oil marketers and depot owners in Nigeria have clashed over allegations of the diversion of 16.6 billion liters of fuel to neighboring countries. A top official at the Depot and Petroleum Products Marketing Association of Nigeria, speaking anonymously, has said that the unabated fuel scarcity is partly due to the diversion of products to neighboring countries by marketers. An estimated 46 million liters of petrol is diverted daily. This means about 16.6 billion liters is allegedly diverted annually. And in northern Africa, inflation in Egypt slowed in June after a 6-month acceleration that left the country facing some of its biggest cost increases in years. Consumer prices in Egypt rose 13.2% from a year earlier, down from 13.5% the previous month. But in a sign that price pressures remain intense, a core index that strips out volatile items such as food and energy jumped to an annual 14.6% in June. It's now at the highest since 2017, after more than doubling from the start of the year. A 1.8% monthly decline in the cost of food and beverages, which makes up the largest single component of the inflation basket, was one of the main drivers behind the latest slowdown. The annual increase in June was down to 22.3% from 24.8% in May. Now, should we all be tightening our belts a little more with fears of a global recession looming? We get into that after the break. The world economy has witnessed 4 global recessions over the past 7 decades, in 1975, 1982, 1991, and 2009, and now another could be impending. The International Monetary Fund's Managing Director, Kristalina Georgieva, says that since April 2022, the outlook for the world economy has deteriorated noticeably. She noted that the spread of high inflation, significant increases in interest rates, China's slowdown, and escalating Russian sanctions were part of this basket. While noting that the rest of 2022 will be tough, she said things may be even tougher in 2023. Global economies are experiencing severe turbulence, and central banks have begun aggressively raising interest rates to tame high levels of inflation, which are now evident in many regions of the world. In April, the IMF slashed its global growth forecast from an estimated 6.1% in 2021 to 3.6% in 2022 and 2023. It is expected that the IMF will cut its global forecast further late this month. This will be the third downgrade this year. The World Bank's Global Economic Prospects report has also raised the risk of stagflation, or a protracted period of feeble growth and elevated inflation with potentially harmful consequences for middle and low-income economies alike. Joining me from Lusaka, Zambia is Mtwalo Msoni. He's an economist and researcher, and we'll be going through these looming fears together. Mtwalo, welcome once again to Business Edge. It's good to see you again.
Thank you very much. Pleasure is mine.
So we're hearing from the International Monetary Fund's managing director that the world is likely heading towards a recession. Let's quickly look at the indices that we're seeing right now that make this a very realistic possibility.
So like you rightly mentioned, the drivers of this are particularly the rise in inflation across the globe. And we have seen this trend across the different continents. And to curtail this, what central banks are doing is that they're increasing their interest rates in the hope of curbing money supply and curb inflation by doing that. You see, inflation can be either cost push or demand pull. If it was demand pull inflation, it would be an indicator of growth in the economy. But this time around, it's cost push inflation, which is being driven by the increase in the primary commodities that are needed in the production process, and in this case, fuel, which brings us to the other drivers of what would be the global recession, which is the China, the slowdown in the growth of China, as well as the Russia and Ukraine war, which has come with its own sanctions on Russia. So essentially, what we're looking at here is a form of cost push inflation, meaning that the cost of production of goods and services has gone up. This is driven by increases in oil prices, increases in commodity prices. To curb this, central banks are reducing on the money supply by applying their monetary tools in form of increasing interest rates, raising the cost of borrowing, making it very difficult for people to access money. If you do this, you're probably headed towards less growth, and a recession might be looming depending on how interest rates are going to increase over time to try to curb this type of inflation.
So you mentioned, of course, China's slowdowns, and that, of course, is coming off the back of major reintroduction of lockdowns in big cities like Shanghai and even Beijing. And that is separate from the Russia-Ukraine situation. So was there a possibility of a global recession coming off the back end of COVID-19, or it's solely because of the Russia-Ukraine crisis that we really seem to be pushing towards the edge of the precipice?
With the coming of vaccines, more people getting vaccinated, what we noted was growth of 6.1% in the year 2021. What we are noting now is a decrease in projections, the third decline in projections of growth. This can be largely attributed to Russia and Ukraine sanctions, no doubt. Before we had this war going on, we experienced growth. Now we have the war, we have increases in oil prices, we have escalating inflation, which is also being driven by climate change to some extent, the decrease in production of agricultural produce. We have this thing going on. In May at the World Economic Forum, the IMF had made mention that a recession was looming, but very unlikely. 2 months later, we are seeing the statement changing to say we cannot rule out the recession. So this basically indicates that with the continued sanctions on Russia, the continued increase in inflation rate across countries and responses by central banks would essentially entail we are not going to see much growth coming from this year. And maybe it's important to mention from an economic perspective, the slowdown in growth is necessary this time around because of the increase in inflation. The UNDP released a report this week that projects that 71 million more people are going to fall or have already fallen below the poverty line. 71 more people have become poor. This is because the basic needs basket is no longer affordable for this 71 million, driven by inflation. So maybe a decline in growth is necessary this time around.
So let's look at the responses, as you mentioned, we're getting from the central banks around the world, and they're aggressively trying to tackle this by raising interest rate hikes. We've seen the U.S. Federal Reserve hiking rates 3 times already this year, so much so that it's at the highest point it's been since about 1994. But also when you look at this interest rate sort of equation, it gets to be a bit theoretical, basically saying that you can use interest rate hikes to combat inflation, raising interest rates to actually work on inflation. Has that ever really worked? Is it enough to prevent a global recession, especially when you see that we're seeing the interest rate hikes, but it doesn't seem like we're seeing a corresponding adjustment or response from the markets?
For goods and services, people have money in the economy, so to reach an equilibrium, suppliers, those who are selling, increase the price. There's growth in the economy, and you can curtail this inflation very well by raising the interest rates, making money scarce, reducing the money supply, making the cost of borrowing money expensive. What we are looking at is definitely a cost push inflation driven by the primary inputs that go into the production process. And a large part of this is energy, oil. Cost of oil has increased. So for you to keep this type of inflation using the monetary policy tools, it's not as straightforward as it would be if it was a demand pull inflation. And this is why we've seen even the big economies like the US revising their interest rates 3 times, reaching a high in about 25-year period. It's because it's very difficult to curtail costs, push inflation using monetary policy tools, which are better placed to curtail demand for inflation. And perhaps it's important to mention that the challenge with the form of cost push inflation that we are facing now is that the inflation, of course, drives more and more people to afford less of what is regarded as their basic needs basket.
Yeah. All right, Mtwalo, we're going to take a break, and I like that we're ending here as well, because now when we come back, the focus has to be on what African countries need to prepare for if we do, in fact, enter a global recession, and if there is anything that can be done to pull us back from the back of this. Now, the IMF has warned that the global economy could be facing another recession, which would make it the 5th in about 8 decades. But is there opportunity for us to move back from that? And if we do enter a recession, how will African economies fare? The conversation after this. COVID-19 pushed the African continent into the first recession in decades, and millions were pushed into poverty, and the pandemic, along with its knock-on effects, rolled back the gains that the continent had made. Recovery has been slowly gaining momentum with the easing of lockdown measures, mass vaccination campaigns, and the reopening of countries' economies. But all of that could be in jeopardy with the Russia-Ukraine conflict pushing up food, fuel, and living costs across the continent, and now possibly pushing the global economy towards recession. So with me is Mtwalo Msoni, economist and researcher, as we continue looking at the IMF warning of looming, the potential of a looming global recession. Now, Mtwalo, let's look at this. We see that developing economies, particularly like the ones on the continent, are often the hardest hit when we have a situation like this. We are already experiencing higher food and fuel prices. Cost of living has skyrocketed as well across the continent. How much worse do you think it can get? And if we were to enter into another global recession, what would happen to us here on the continent?
Well, I think it's important to mention that in response to the higher prices, the higher cost of living, we would want to see an increase in social service delivery. Social cash transfers forming probably a major part of the social welfare that would want to see cushioning people from poverty. But what that does is it takes away necessary spending for other sectors and forces our African countries to borrow. Unfortunately, we have a debt crisis currently on the African continent. We've seen lots of countries stretching over the 60% debt to GDP ratio, and would inevitably see more and more countries enter this debt crisis as they tend to try to cope with increases in prices and trying to cushion the population from the effects of the increase in commodity prices. One thing that is also important to mention, maybe pertaining to Africa, is the fact that currently we are a net importer of energy, net importer of oil, net importer of essential commodities that go into the production process. So if we're seeing this global inflation, which is mainly hitting these commodities, it basically means that the cost of production. So I mentioned that the African continent is a net importer of energy. We rely on the outside world for our energy needs. We rely on the outside world as well for most of the inputs in the production process, especially related to technology. So if there's an increase in the primary price of purchasing these, it essentially means there'll be multiplier effects on the price of purchasing the products that come from these inputs in the production process. The higher the price, the less affordable things become for the nations, for people of the nations, hence driving more people into poverty. One way that we have over the years employed to get out of this is by borrowing. And we've seen countries having to deal with a debt crisis where the debt becomes very unsustainable. Most African countries are cruising beyond the 60% debt to GDP ratio. Mm-hmm. We borrow to try to cope with these changing times, to try to cope with inflation, and try to provide for social welfare.
So let me ask this. If there, aside from the Russia-Ukraine crisis possibly ending today, and we're able to get some, I know Ukraine and Russia both are entering into harvest season as well. Let's say the Russia-Ukraine crisis was to end today, what else would be needed to be able to pull the world back from the edge of this precipice, to pull the world back from the potential of a global recession? And even if that doesn't happen, are we guaranteed to enter one in the direction that the world is going right now?
So, like we made mention at the first, I think there are 4 drivers, and I'll add a 5th: climate change. Most of East Africa has been unable to produce enough food to feed its population because of the drought. There's a surge in inflation, which, even if the Russia-Ukraine war was to end today, would still be looming around for some time. There's been an increase in across countries. Money of borrowing money has become so there are so many things that need to be what we are commodity prices has been...
Mtwalo, we're having some issues with your connection because I would like to get your final thoughts on this, but let's see if we can't sort those connection issues so we can hear you very well. So Mtwalo, are you still with me?
Yes, I'm still with you.
Okay, so let's quickly go ahead with the answer in terms of whether or not we are guaranteed in one way or the other to find ourselves in a global recession in the coming months.
Well, we are not guaranteed to find ourselves in a global recession. I think 3.6 projected growth is still far away from a global recession. But if the current trend continues, then we might be headed in that direction.
And so finally, let me ask this.
If the current trend continues, we're headed in that direction. But 3.6 is a very long way to go.
Okay, so finally, let me ask this. If we do not end up in a global recession, many fingers, toes, and whatever is crossable are crossed. We do know that the IMF is saying that this tough times will project into the second half of 2022 and also carry over into 2023. It's going to stretch for a long time. So when you look at that, why is it likely that we're going to continue to struggle into the new year and maybe possibly into the tail end of 2023?
I think we are basically going to struggle because with the sanctions that were imposed on Russia, it brought about disruptions in the global supply chain, and unfortunately, the essential commodity oil, which drives the current state of the globe, is affected. We are under a climate crisis currently, and to cope with the climate crisis, we need the development of climate-friendly technology, and we're headed towards the energy transition. And while we are still transitioning, I think we'll have to bear the brunt of the higher purchase of energy. So I think this is why the projections go on for quite a long time till we figure out this energy crisis that we are in currently, till we fully transition and are able to meet the needs of the future generation. I think we'll still see such increases in commodity prices and would still be headed towards lower projections of growth.
All right, Mtwalo Msoni, thank you so much for joining me. I hope it won't be as long before we have you back on Business Edge.
Great. Thank you.
And that conversation is one we'll continue to follow. The IMF has sounded the warning bells. It could be that there will be no fifth global recession, but while there may not be, the issues that many across the continent are struggling with, higher food and fuel prices leading to higher living costs, are issues that must be attended to whether or not there is a recession. You're watching Business Edge. Now, while Nigeria Stock Exchange has recovered slightly, news of 121 firms delisted from the Nigerian Exchange Limited in the past 20 years is raising some questions. But before that, we have international business news up next. Stay with us.
Welcome to International Business News. I am Lekon Onobanjo. And we start by telling you that analysts and investors are concerned that impending corporate earnings season could lead to another significant decline in share prices globally because profit expectations are far too optimistic in light of the growing likelihood of a recession. World stocks are in a bear market after losing more than $20 trillion in value since reaching record highs in January as major central banks seek to tame soaring inflation without impeding burgeoning growth. Prices have decreased below historical averages, lowering bargain seekers. However, recent profit warnings from American retailers, namely Target and Walmart, as well as European pandemic winners Zalando and B&M, have traders concerned about a sequence of downgrades as customers curtail spending and spiraling energy and other input prices pinch. The Society of Chartered Surveyors Ireland predicts that when market inflation slows after the post-pandemic boom, home prices will rise by 3% in the third quarter of 2022 and by 4% during the following year. According to John O'Sullivan, chair of the SCSI Practice and Policy Committee, annual rates of inflation of 14 to 15% seen in recent months were not sustainable over the long term. He also said that the 4 to 5% forecast must be viewed in the context of near record levels of inflation in the larger economy. O'Sullivan mentioned rising interest rates, supply chain problems, geopolitical instability brought on by the Ukraine conflict, and the persistent lack of new housing supply, with the central bank expecting just 24,500 new dwellings to be finished in 2022, rising to 29,000 in 2023 and 33,000 in 2024. Away from that, the International Monetary Fund has said that Ireland's economic outlook remains positive despite substantial uncertainty due to the war in Ukraine. The International Financial Institution says that while growth is expected to remain strong, Ireland will likely face economic indirect effects of the war to rising inflation levels and a decline in global demand. In the report published following its annual review of the Irish economy, the IMF said that pre-pandemic challenges remain for Ireland's economy, including housing shortages, infrastructure, and a gap in green and social investments. Reform of insurance capital rules would free up to £90 billion. That's about $108.05 billion of capital for investment, but it should not be a free lunch that puts pensioners and policyholders at risk. Changing insurance rules, known as Solvency II, that were inherited from the European Union, is seen as a key Brexit dividend for Britain's financial industry, but the pace of reform has dismayed insurers. Bank of England Deputy Governor, that is Sam Woods, said the industry was opposed to how the bank wants to change the so-called matching adjustment, which allows insurance companies to recognize as capital upfront a part of the income they expect to earn on their assets in the future. And finally, President Biden has been asked to collaborate with international partners on regulating cryptocurrencies as part of a new initiative by the United States Treasury. In a memo to the president, the U.S. Treasury stated that it would like to create international standards for digital payments and central bank digital currencies in order to safeguard customers and businesses and maintain financial stability. The agency advises that the United States keep working with the G7 on cryptocurrency, concentrating on money mobility in the public and private sectors, lowering payment inefficiencies, and adoption of new technology. And that's about it on international business news. We go on a break now, and when we return, it is mixed feelings as the Nigeria Exchange Limited ended trading on Thursday with the first bullish results of this week. This good outing is coming on the heels of some firms being delisted from the Nigerian Stock Exchange platform. When we return, that will be our next discussion on Business Edge. Do stay with us.